Welcome to NorthFlow Finance. Market downturns can feel terrifying. Portfolios shrink, headlines scream, and the instinct to sell everything and hide in cash becomes overwhelming. But history has consistently shown that the investors who come out ahead are the ones who stay calm, think long-term, and use crashes as a rare opportunity to buy world-class businesses at a discount. In that spirit, today we are looking at 3 TSX-listed stocks I would buy without hesitation if markets took a serious tumble: Loblaw companies, Alimentation Couche-Tard, and Canadian Net REIT. Each one mirrors the defensive logic behind the popular American trio of Walmart, Philip Morris, and Realty Income, but with the added benefit of being denominated in Canadian dollars and rooted in the Canadian economy. Let us get into it. Before we get into the specific stocks, it is worth spending a moment on the mindset. Most investors look at a falling market and see danger. The great investors look at the same falling market and see a sale. The underlying businesses have not changed. The grocery stores are still selling food. The convenience stores are still selling fuel and snacks. The commercial properties are still collecting rent. What has changed is the price tag, and when high-quality businesses get cheaper for reasons that have nothing to do with their fundamentals, that is the definition of opportunity. The 3 companies we are covering today are not exciting in the way that technology stocks are exciting. They do not promise to change the world. What they offer instead is something far more valuable for long-term investors: durable business models, conservative payout ratios, and a consistent track record of growing distributions through good times and bad. That is exactly what you want to own when markets get turbulent. Our first stock is Loblaw Companies, trading on the TSX under the ticker L. If Walmart is the definition of a recession-proof retailer in the United States, Loblaw Companies plays exactly the same role in Canada. As the country's largest food and pharmacy retailer, Loblaw operates thousands of locations under banners that Canadians visit every single week: Real Canadian Superstore, No Frills, Zehrs, and Shoppers Drug Mart, to name just a few. When the economy stumbles, people do not stop buying groceries or filling prescriptions. That is the simple, durable logic behind owning Loblaw. It is a business built around human necessity, not discretionary spending, and that makes it one of the most resilient stocks on the entire TSX. The financial fundamentals back up the story. Loblaw recently reported adjusted diluted net earnings per share growth of 10.9% in its fourth quarter. The company has maintained a 5-year dividend growth rate of approximately 10% annually, remarkably consistent for a business this mature. The payout ratio sits at a very conservative 26 to 30%, meaning the company distributes only a fraction of its earnings as dividends, leaving enormous room to keep raising the payout even in lean years. Most recently, the board declared a quarterly dividend increase of 10%, a loud signal of management's confidence in the business. That kind of confidence from the boardroom matters. It tells you management sees the future clearly and is willing to commit capital to shareholders based on that visibility. At current prices, Loblaw trades at roughly 28 times earnings, which is not cheap by historical standards. But a market crash could compress those valuations meaningfully, creating the kind of entry point that long-term investors wait years for. Think about what that means in practice. A 20 or 30% market decline would bring a business generating double-digit earnings growth, with a 10% dividend growth rate and a rock-solid balance sheet, to a genuinely attractive valuation. The combination of an essential business model, disciplined capital allocation, and a growing dividend make Loblaw a compelling anchor stock for any Canadian portfolio. In a crash, it is the kind of stock you buy and forget about for a decade, and come back to find it has compounded beautifully. Our second stock is Alimentation Couche-Tard, trading under the ticker ATD. Philip Morris International attracts investors because of its global scale, its dominant market position, and its ability to grow earnings and dividends regardless of the economic environment. Alimentation Couche-Tard fits a remarkably similar profile, a Canadian-born company that has quietly become one of the largest convenience store and fuel retail operators in the world, with thousands of locations across North America, Europe, and Asia under brands like Circle K and Max. Most Canadians know the name, but fewer appreciate just how global and how dominant this business has become. It is one of the great Canadian success stories of the past 3 decades, built through disciplined acquisitions and relentless operational improvement. What makes Couche-Tard exceptional is its relentless track record of dividend growth. Over the past decade, the dividend has increased by an average of 26% per year. Read that again, 26% per year, compounded, for 10 years. Over the past 5 years, the annual dividend growth rate has averaged nearly 20%. The most recent quarterly dividend was raised by 10.3% to 0.215 Canadian dollars per share. And crucially, the payout ratio remains extremely conservative. Only about 24 to 27% of earnings and cash flows are paid out as dividends, leaving the company with enormous flexibility to keep raising the payout while simultaneously funding acquisitions and store modernization programs. The third quarter of fiscal 2026 showed the resilience of the business. Earnings per share rose from 68 cents to 82 cents, a gain of more than 20% year-over-year, driven by same-store sales growth across all geographies. Analysts at RBC Capital recently raised their price target to 106 Canadian dollars, and JP Morgan initiated coverage with an overweight rating, reflecting broad institutional confidence in the long-term trajectory. Like Philip Morris, Couche-Tard is not a flashy growth stock. It is a cash-generating machine built to compound quietly over decades. A market crash that pushed its stock price down would simply mean buying a better business at a cheaper price, the kind of opportunity that defines great long-term investing. When a company is growing earnings at 20% and the stock falls 30% in a broad market sell-off, the math becomes almost irresistible for a patient investor. Our third stock is Canadian Net REIT, trading under the ticker net.un. Realty Income has built its legendary reputation on a simple formula: own properties, sign long-term net leases with high-quality tenants, and pay a growing monthly distribution without fail. Canadian Net REIT operates on an almost identical model, which is why analysts have described it as the Canadian equivalent of Realty Income, and why it belongs in the same conversation. If you have ever looked at Realty Income and wished you could find something similar in Canada, denominated in Canadian dollars, with a similar lease structure and a similar income philosophy, Canadian Net REIT is the answer. Canadian Net REIT owns a diversified portfolio of commercial properties across Canada, all leased on a triple net basis. Under triple net leases, tenants are responsible for taxes, insurance, and maintenance costs, making cash flows highly predictable and shielding the REIT from the operational headaches that plague other real estate businesses. The portfolio currently boasts 100% occupancy, anchored by national tenants, which provides a level of income security that is rare in the REIT sector. The current dividend yield is approximately 6.3%, and the FFO payout ratio sits at just 53%, one of the lowest in the Canadian REIT universe and well inside the sweet spot range of sustainable distributions. For context, many REITs with payout ratios above 85% are already at risk of cutting their dividends. At 53%, Canadian Net REIT has a wide buffer, nearly double the industry danger zone. The stock trades at approximately 8.5 times 2025 FFO and 8 times 2026 FFO, a steep discount to larger REIT peers, suggesting significant valuation upside as the business continues to grow through acquisitions. Over the past 3 years, the dividend has grown at an average rate of 5.4% annually. The company is small, with a market capitalization of around $120 million, which means it flies under the radar of most institutional investors. But for individual investors willing to look beyond the big names, that same small size is what creates the valuation gap. A market crash that drags net.un down alongside the broader market would represent one of the most attractive entry points for income investors in the Canadian market. What ties these three together is more than just defensive characteristics, it is a philosophy. Each one mirrors a proven American archetype that income investors have trusted for decades. Loblaw is Canada's Walmart, essential retail that generates consistent cash flows regardless of what the economy is doing. Couche-Tard is Canada's Philip Morris, a global cash-generating machine with a dividend growth record that is almost unmatched anywhere on the TSX. And Canadian Net REIT is Canada's Realty Income, triple net leases, predictable cash flows, and a growing monthly distribution. The difference is that all three are denominated in Canadian dollars, giving Canadian investors natural currency alignment and eliminating the foreign exchange risk that comes with owning the American equivalents. For a Canadian investor building a dividend portfolio, this trio covers the essential bases. Let us bring this together into a practical framework for crash investing. When a market sell-off hits, run every stock through these 4 questions. First, is this an essential business? Can the company keep generating revenue even if consumers are cutting back and the economy is contracting? Loblaw sells groceries and prescription drugs. Couche-Tard sells fuel and convenience items. Canadian Net REIT collects rent from national tenants on long-term leases. All three pass this test with flying colors. Second, is the dividend well covered? A crash is not the time to be buying high payout stocks that are one bad quarter away from a cut. All three of these names have payout ratios well below the danger zone. Third, has management demonstrated a commitment to dividend growth over time? Not just 1 or 2 years, but a sustained track record through multiple economic cycles. All three qualify. And fourth, does the crash actually create a better entry point? If a stock is already fairly valued in calm markets, a 10% pullback may not be enough. But a genuine crash, 20, 30% down, changes the math dramatically on all three of these names. Market crashes are not the enemy. For investors in stocks like these, a crash is simply a sale, a rare chance to buy dependable, dividend-growing businesses at prices that would otherwise take years to reach naturally. That is the mindset that separates patient, successful investors from the crowd. The crowd sees a falling portfolio and panics. The disciplined investor sees a falling price on a business that has not changed, and acts accordingly. Loblaw, Couche-Tard, and Canadian Net REIT are not exciting companies in the way that technology stocks are exciting. They do not promise to change the world. What they offer instead is something far more valuable for long-term investors: durable business models, conservative payout ratios, and a consistent track record of growing distributions through good times and bad. If markets fall hard, I will not be reaching for the sell button. I will be looking at L, ATD, and net.un, and adding to positions with confidence. That is a wrap on today's video. If this analysis was useful, please hit the like button. It genuinely helps this channel reach more investors who are trying to think long-term. Subscribe so you do not miss our next deep dive into Canadian markets and dividend investing. And drop a comment below: if markets crashed tomorrow and you could only buy one of these three, Loblaw, Couche-Tard, or Canadian Net REIT, which would you pick first, and why? We read every comment and it shapes what we cover next. Thanks for watching NorthFlow Finance, and we will see you in the next one.